You are being lied to about homeowners HIP, not by accident, by design. The banks, the mortgage industry, the financial media, they all want you believing that your only option is to walk in, take whatever rate they hand you today, sign a 30-year sentence at 6.3%, and be grateful for it. And while you're doing that, a small group of buyers in 2026 are legally stealing 3% mortgages that were locked in back in 2021. Same homes, same neighborhoods, less than half the interest, and in some cases, $0 down. And I went from bankruptcy in 2007 to building multiple seven-figure businesses. And I'm telling you right now, this is the single biggest wealth transfer happening in real estate today. And almost nobody on your side of the table is talking about it. It's called an assumable mortgage. And today, I'm going to show you exactly how it works, how to find these deals hiding in plain sight, and how to structure an offer that gets you into a home with a 3% rate and zero out of pocket. But stay with me, because there's one thing that kills most of these deals before they close. And I'm going to show you how to make sure that doesn't happen to you. Here's the core concept. When most people buy a house, they go get a brand new mortgage at whatever the current rate is. Right now, that's around 6.3%. But an assumable mortgage lets you take over the seller's existing loan. You step into their shoes, their rate, their balance, their payment schedule. So if that seller bought their house in 2021 when rates were 2.75%, you inherit that 2.75% rate. Let's do the math, because this is where the middle-class mindset will blow your mind if you let it. Same $400,000 loan at today's 6.3% rate, your monthly payment is $2,467. At an assumed 2.75% rate, $1,634. That is an $833 difference every single month. And over 30 years, you save nearly $300,000 in interest. That's not a hack. That's generational wealth sitting inside somebody else's mortgage. Now here's what most people ask. JD, if this is so good, why isn't everyone doing it? And that's exactly the right question, because there's a catch. And if you don't understand it, you're going to walk away from the best deals on the market. And I'll show you exactly how to solve it in a minute. Real talk, not every mortgage can be assumed. Most conventional loans, the ones sold to Fannie Mae or Freddie Mac, have what's called a due on sale clause. That's basically the bank saying, if this house changes hands, pay us back everything. Game over. But here's the good news. Government-backed loans, FHA, VA, and USDA, are explicitly designed to be assumable. And here's why that matters. A huge wave of homes was bought between 2020 and 2022 with FHA and VA loans at historically low rates. Those properties still exist. Those loans are still attached. And those sellers, they need to move. VA loans are particularly powerful because they can be assumed by both veterans and civilians. FHA loans are available to anyone who qualifies credit-wise, minimum 580 credit score in most cases. And USDA loans cover rural and suburban areas. My friend Eric, who used to work in mortgage processing, told me something a couple years ago that I never forgot. He said, JD, the number of sub 4% FHA and VA loans still out there is staggering, and most buyers just don't know how to find them. So how do you find them? And here's where it gets really interesting, because finding these deals requires a completely different approach than how you normally search for homes. The MLS, the database your real estate agent uses, doesn't always flag assumable as a searchable field, which means most buyers and most agents never see these opportunities. That's not a bug in the system. That's just how the information gap works. And the wealthy exploit information gaps. And here's your tactical playbook. First, search MLS listings manually for keywords, things like assumable, VA assumption, FHA rate transfer, or takeover payments, buried in the listing description or agent remarks. Second, look at Zillow or Redfin's mortgage history section on any listing. If a home was purchased or refinanced between 2020 and 2022, there's a real chance that loan is sitting at 3% or below. Third, and this is the move most people miss, Use dedicated platforms built specifically for this. Roam, AssumeList, Assumable.io. These services cross-reference public mortgage data with active listings to surface confirmed assumable FHA and VA loans. AssumeList alone has over 39,000 active listings with sub 5% rates. You can filter by location. And this is the tool the middle class doesn't know exists. Drop a comment right now. Have you ever heard of assumable mortgages before this video? Let's see what we're working with. Okay, so you found the deal. You've got a seller sitting on a 2.9% FHA loan. You want it, but now you hit the wall that stops 90% of buyers cold. And I'm going to show you how to blow through it. Here's the real challenge, and I'm not going to sugarcoat it. Let's say a seller bought their home for $300,000 in 2021. Their remaining loan balance today is $250,000, but the home is now worth $450,000. You can assume that $250,000 loan, but what about the other $200,000 in equity the seller has built? They're not giving that away. This is called the equity gap, and it's the reason most people give up on assumable mortgages after the first Google search. But here's what the wealthy know that the middle class doesn't. You stack financing, you layer it. Option 1, a secondary loan. Specialized lenders offer what's called gap financing, a second mortgage that sits behind the assumed loan and covers the equity difference. Navy Federal Credit Union allows up to 100% combined loan to value for VA loan assumptions if you're military. Blaze Credit Union does the same for civilians. You're taking two loans, but your blended interest rate, the average across both, is still significantly lower than starting fresh at 6.3%. Here's the math. You assume $300,000 at 3%. You take a second loan for $100,000 at 8.5%. Your blended rate across the full $400,000, about 4.5% versus 6.3% for a brand new mortgage. That's still saving you $300 per month, every month. Option 2, seller carryback. The seller acts as the bank for their own equity. Instead of you paying $150,000 in cash, they carry a private note. You pay them monthly with interest. The terms are completely negotiable between you and the seller. And for a seller who's motivated to close fast, this is a compelling offer. Option 3, down payment assistance programs. Programs like the Chenoa Fund allow DPA funds to be paired with FHA assumptions to reduce your cash to close. Some state programs offer second mortgages up to 8% of the purchase price specifically to bridge this gap. The plot twist? When you structure this right, assumed first mortgage plus a secondary gap loan, you can get to zero out of pocket. It's not common knowledge, but it's completely legal and it's happening in 2026. But finding the deal and stacking the financing is only half the battle, because there's one more thing that can absolutely kill this entire transaction if you don't handle it correctly. The mortgage servicer, the company that collects the payments, has to approve the assumption. And historically, these guys have been slow, like 120 to 180 days slow, long enough to blow up your purchase contract. And here's the good news. The VA now mandates servicers must decide on VA assumption applications within 45 calendar days of receiving a complete package. HUD has pushed similar reforms for FHA loans. The operative word there is complete. If your package is missing anything, one page of a tax return, one bank statement, the servicer can reset the clock. And I've seen this happen to buyers who were 3 months in. So here's how you protect yourself. The day your offer is accepted, you submit one single, complete index PDF to the servicer's assumption department, not general customer service, the assumption department specifically. That package includes 2 years of tax returns, pay stubs from the last 30 days, 3 months of bank statements, your signed purchase agreement, and a written explanation of any credit inquiries or income changes. Everything in one shot. And if they drag their feet past the 45-day deadline, you file a complaint with the Consumer Financial Protection Bureau. Their portal requires the servicer to respond in 15 days. That tends to break the logjam fast. My friend Will, who's been in the mortgage business for years, said it plainly. Most assumptions fail because the buyer doesn't know how to push the right buttons on the back end. Now you do. Let's bring it all together because I want you to leave here with a clear picture of what this actually looks like. You find a home where the seller has a 2021 era FHA or VA loan at 3% using AssumeList or Roam. You structure an offer that includes the assumption plus a secondary gap loan or a seller carryback to cover their equity. $0 out of your pocket. You submit a complete application package to the servicer on day one, and you hold them to the 45-day timeline, and you close on a home at a rate the rest of the market is paying double for. That's not financial fantasy. That is a real executable strategy in 2026. While everyone else is waiting for rates to come down, you're using rates that never went up. Now, here's the next problem you'll face. You'll find the property, you structure the deal, but the seller doesn't understand why the assumption is better for them than a traditional sale. That's a real friction point, and it's one most buyers don't know how to solve. I'm going to cover exactly how to pitch an assumable deal to a seller in an upcoming video, because your offer has to solve their problem, not just yours. Make sure you're subscribed and notifications are on so you don't miss it. If this broke through the noise for you, smash that like button. It tells the algorithm that this is information people actually need, and that's how we reach more people stuck in the middle-class money trap. Stay disciplined, stay informed, and remember, wealth is built on information gaps. Now, you've closed one. Peace be with you, and I'll see you in the next one.